That's a funky song, man. We need a sad song. We need a sad one. Like the jazz blues, man. That's it. I can't think of it. Send in the Clowns, maybe, if there's like a jazz version of Send in the Clowns. You know that song? Sad song by a sad lady. Hey, welcome to the closing beat, everybody. Happy Wednesday. It's Wednesday already. Yeah, week is flying by here. Hey, we're financial advisors here at Jazz Wealth Managers. Thanks for checking us out. jazzwealth.com. Just a different type of advisor, man. I study the other advisors. I get all the magazines and stuff, and I'm like, what are we doing? We're not talking to the average person. You're talking to some stuffy suit and tie. I can't put my head around it, but apparently it's working for them. I don't know. I'm just here for the every man, every woman, and I hope you'll check us out there. I appreciate that. Tomorrow's Wine and Wealth. We're trying to get things set up and maybe do something a little bit different here, but if you're a client, you can join us, of course. It is free and open, and tomorrow will be open to research members as well, if you're a research member. The FinTips videos are free. You can check those out on the website if you're interested in that one. Me and Eric are conquering that one. He's killing it, so we're going to keep going with that one there. And that's all I got, so let's take a look at the market. More red. You see it off to the right-hand side of your screen. Again, those numbers are not fake. They're not mistyped. That is the real deal there. Inflation. Right smack in the middle of what was expected and what was forecasted and where we were. Right in the middle. So you get early this morning, you see the stock market. I could probably show it here. Early this morning, the stock market's like, wait, we didn't think that one, right? Initial fall off from the report there. The markets open up and it's like, maybe that's good. No, it's bad. Maybe that's good. Maybe it's bad. Maybe we peaked. Maybe we didn't. And then the market just shook it off and said, wait a minute, we're weak right now. That's what we're doing. And so more to the downside here, very, very extended there. We saw inflation grow 0.3%. I think we were expecting 0.2 there. No go. Nope, didn't count there. But you know, that's what it is. So inflation, we could argue, maybe flattening out, but it's certainly not falling, right? Nothing interesting to where we could say the Fed can hold off on their half-point rate hikes and their aggressive talk. So you'd expect more of that from the Fed. They know now that going forward, which I believe tomorrow they have a Fed member speaking. Two of them will be speaking tomorrow. So you can expect that their comments are not going to be dialed back. They're going to keep hammering the concept of inflation, which, remember, it's not good for the stock market. They're going to hammer the idea of raising rates, not good for the stock market. And as we covered yesterday, there's a number of different differences between what now looks like it's going to be a bear market and the last one and the one after that and the one after that, and so on and so on. Just not the case there. The Fed basically has the green light to go ahead with another half-point rate hike if they want, and I expect that you'll hear them start to talk about it. All right, if we look at the S&P here today, big tech was actually the ones that led the way on the downside. It really didn't matter if anything was going to try to bounce today. And at one point, by the way, the majority of the stock market was actually fairly green. And then it started getting kind of messy and stuff because you had Apple lower on the day and never really showed any signs of bouncing, and that's a big weight on the market there. They're a big, big contributor. Microsoft's another one. That's a pretty brutal day for Microsoft, 3% lower. Facebook is the same thing, 4.5%. Amazon, 3.25%. These are already very extended stocks. Tesla, not immune to the weakness out there. Down about 8.25%. Semiconductors, right? You want to see some blood? Go to semiconductors there. Nvidia, Qualcomm, Broadcom. It actually fared okay relative to everything else and has been. But you got Applied Materials, some of the smaller ones you're not used to hearing about. They were also weak. The big ones, Intel, Texas Instruments. It was tough. Tech stocks in general, right? You got Salesforce down lower on the day. KLA 10 Core, not one that we often look at, but really bad there. PayPal, the weaker stocks like PayPal that had already been weak continue to see their little bloodbath there. Well, it was pretty nasty there. And like I said, at one point, it wasn't too bad. Like Merck actually was making new highs. Healthcare stocks were making new highs. Eli Lilly actually had a pretty strong day at one point, and it just it just faded away. Visa is another one. Actually, Visa did okay. Finished pretty good there. You'd have to look to energy, which even those closed off of their highs, but that was the strongest area today. That's where you'd have to look if you wanted to find any kind of green. Consumer staples even. A lot of those have been starting to weigh down a little bit. Remember, they're overbought, so that's not like panic selling. That's just profit taking. That's the one area you could say that. Philip Morris was against the grain there a little bit. If you're familiar with or like investing in that sort of thing. I showed Coke there just a second ago, so just point that out. You got to go to the stable stuff here. You know, the way that people are looking at the market here is they want to invest in profits now, not profits later. That's probably the easiest way to say it. You have bigger companies, well, Uber, being one of them, but you have these bigger companies that say, look, we're on our way. You're investing in the growth now for the opportunity of future large sums of profit. And investors are like, no, I'll take who's making a profit now, Philip Morris. I'll take the Coca-Colas of the world because I can count on them to go out there and make some money. But I'm not going to mess around with your smaller growth companies, or I'm not going to mess around with PayPal, not going to mess around with some of the semiconductors and try to guess that this magically recovers itself here. That'll change over time, but that's where we stand. Now, with the S&P, you got about 2.5% more until we hit a bear market, which normally I would say, all right, yeah, you got about 2.5% more. Now, that could be one day. We could have a bear market tomorrow. That's how active the stock market is. So it's like, all right, just get it over with. Right? If we're going to be down 20%, just make it happen. Of course, the Nasdaq is down 20% as well. And I got a new thing today. If the stock market worries you right now and you own any kind of crypto, I don't want to hear it, right? Think about that. There are so many people that say, oh my God, the stock market's making me nervous. Maybe I should go to cash or do something. What are you doing with your Bitcoin? Right? What are you doing with all your other crypto, your stable coins, for God's sakes? Those are not so stable. Those are horribly unstable right now. So I don't want to hear it, right? If you're nervous about the stock market and you're not doing anything with your Bitcoin there or whatever you're doing over there, I just don't want to hear it. What's happened, though, with the S&P, earnings, which normally would have been a market driver, have taken a back seat, right? So if you look at the earnings so far for this quarter, which is basically over, when you look through, not really, we got a little bit more to go, but you look at earnings, we're showing in the S&P 11% growth. Normally that'd be good news. Double-digit growth, I'll take that one there. Sales growth of 13.5%. That would normally be all we talked about right now. Who's the rising stars, who's looking great, and who's not contributing to the S&P there. That'd be all that we were talking about. But the concept right now is investors say, I want to go for profit now, consumer staples, versus profit potentially in the future, which would be tech. Right? And you could see that clear as day. That's probably the easy way to tell your friends and talk about it there. And that's why you see that. So mentioning the Coca-Cola, mentioning your Philip Morris and so on, and that's where everybody's going. They've been there. I've been talking about that over and over again. And it's because we can see, holy cow, that's what's driving profits right now. That's where the sales are. That's where the revenues are. But we don't have this, of course, over in the stocks that are going to need to borrow more money in order to keep growing and all that. And I think you get that picture by now. So a little bit something different to talk about. Anyways, you got the Nasdaq. Well, the Nasdaq now finds itself down 26% year to date. And I say year to date because that's basically where we hit the top in the market. It was a little bit before that, but you could basically use year to date performance to see how far off of the highs we are. What's interesting is now this is kind of nasty. Here is as best I can. I'll try to make it a little bit more obvious for you. Here is the Nasdaq Composite, not the Nasdaq 100, the Nasdaq Composite. And what I've done is I said, okay, every time it pulled back off of a high, I'd just like to see how far it pulled back. So, for example, you've got the COVID decline right here. So we were at all-time highs, and then the COVID decline hit. We all got nervous and did our thing there. Thank God that's pretty much over with. And we fell 29.92%. Let's call it 30%. You see this guy over here? This is to illustrate how nasty of a decline this really is. This is almost worse than the COVID drop off of highs. Now, granted, we're not falling like just a rock. We've fallen and tried to bounce and all that stuff, and we'll eventually try to bounce again. That's what will happen. But this is the worst, almost the worst in 10 years, which normally you can't say that because your biggest drawdown, COVID. Any stock, any mutual fund, ETF, you go, what's your biggest drawdown? COVID. And you can explain what the numbers were. This is about to outpace that. That is impressive there. You have to go back from here, like this is looking back 10 years. You have to go, let's hit max. You got to go back to the .com bust. Yeah. To find a bigger pullback off of highs, you'd have to go right in here, right? So that's right after, if you're familiar with, when everybody wanted to have a .com internet address and raise a bunch of money for nothing that was actually happening. That was all that right in there. So it's about to be nasty. That's the next headline you're going to see. As soon as that Nasdaq pulls back under that 30% off of highs, that's going to get some attention there. So that's pretty nasty, and it is pretty nasty in the Nasdaq. Anything tech related, all the big cap tech stocks were the weak ones today. Moving on, you got crude oil. Big recovery here today. A little bit odd because you actually had a build. That's the way they say it. In Oklahoma, you would say we had a build of inventories of about 8.5 million barrels compared to last week. So normally that would put pressure on prices because we have more supply. Demand is obviously strong, but we'd have more supply to accommodate that demand. Well, the focus is on the lack of oil going to Europe. Remember, they're trying to get themselves off of that. And so it doesn't matter that we have a surplus here, at least for the last week. That made prices move higher there. There's also some things going on with OPEC, NOPEC, and all that great stuff that the Twitter world has come up with. And that could further put release pressure to the upside. I don't know how you say it there. But anyways, that's what's going on with oil. Also, bond yields actually pulled back here a little bit on the day. People are trying to get a little of that guaranteed return in the bond market versus having to go play around in the stock market. Gold is getting a little bit more solidified down here around the 200-day moving average. I don't know that this is an area you want to buy gold. I know it's the best support you've had in a while. But we'll see what happens there. Going through the different sectors today, industries, sectors, whatever. Retail making a new low. They are the latest, or will be the latest to report earnings in this earnings season here. So this will likely stay pretty volatile there. Your best sectors today, basic materials. I don't know if you're interested in the basic materials space, if that does anything for you, but you have a lot of earnings being kind of coming out from them, and a lot of sympathy plays there for basic materials. So CF just had their earnings. It's recovered all of that. As you look around like Lind, there you go. It's not great, right? I'm not saying this was the best performing sector today. It just was one that held up kind of nicely. So you could use the XLB if you want to kind of see some of that or break into different stocks that are inside of it. Utilities did okay here as well. They had the most amount of positive stocks per sector. So that sector had the most amount of stocks that finished the day positive. You got Southern Energy off the 50-day, or at least trying to come off the 50-day there. Nextera, even some of the weaker ones like this, is trying to illustrate that some of these showed some weakness here, or strength as well, even though they have previously been weak. American Electric Power also off the 50-day. That's what you have right now in the utility space. It's either something that was strong and pulled back to the blue line, the 50-day, or it's something that was weak and is well below and is trying to recover. That's the only two directions to look in the utility space right now. There's really nothing else going on. Energy was the best performer here today and had the biggest gainers in terms of those stocks that did finish green. Hess, thought was interesting. It's a hot, sloppy mess up here, but for the moment, that is that's basically what you got there. I don't have a lot of good news. New highs and lows. There was only one new high today. I think it was McKesson, and that is the one. So incredibly strong. You're finding that in the healthcare space. And again, healthcare at some point today was one of the more positive sectors, right? It did okay in terms of having more stocks that were green on the day, but that's it. As far as stocks that are lower, hit new 52-week lows. You're going to have Disney, which did report earnings. I saw they had a couple beats there, and it was higher. It's trading quite a bit lower here after hours. So that's going to, at the moment, it looks like it's going to make a new low tomorrow, down about 3.5%. I think it was pretty much just what was, I don't see anything crazy there for them. So I didn't catch why it fell. It was initially higher. Earnings were basically as expected. And that's all I got for you there. Yeah. Moving on. We'll see what happens on that one tomorrow. Under Armour, probably no surprise. This one's been lower since earnings there. That one hit new lows. Starbucks continues to hit new lows. Now down around $70. And to stick with retail for a second, TJ Maxx. One of the more extended retail stocks right now to the downside. And that's it. Going on to stocks in the news. Going to be earnings related here. So you got Wynn. I find Wynn earnings to be interesting because it's kind of like, are there a lot of people in Vegas? Boston's one of their popular areas. How's Macau doing? Vegas occupancy beat by 1.1%. Total property earnings are still catching up, though. They had a loss versus a gain that they were expecting. Quite a big one. I think they lost like $5 million. They were expected to make like $23 million on Vegas properties. They did not. They still said we see strong demand in the Wynn Vegas and the Encore Boston Harbor. So they're pretty positive going forward. Didn't matter. The stock market wasn't falling for any of those words today. They want to see numbers. Rocket, which is Rocket Mortgage. This is really confirmation of how weak mortgage demand is. I've got some numbers here to share with you real quick. So loan originations for Rocket, if you use them for your mortgage, loan originations down 50% year over year. And that was for last quarter. So really, this has all kind of just started recently here with interest rates spiking really aggressively. So how do you think this quarter is going to look? And that's why people are responding this way here. Loan demand has fallen off a cliff. They do a survey, not Rocket, but the Fed does a survey of senior loan officers to try to get an idea of mortgage originations and things like that. Non-jumbo mortgages have fallen 32%. Since last quarter. Jumbo mortgages, depending on where you live, determines what the jumbo mortgage is. Like, I think in Florida, it's like $575 or something, but California maybe more or whatever. Jumbo mortgages down 36%. The only area, non-residential, flat, government mortgages down 33%, 39%, commercial loans down, up 17%, subprime mortgage loans down 14%. The best performing types of new loans were actually credit card loans. That's not a good sign. So that was up 26% relative to last quarter. So inflation's coming in. Oh my God, let's not buy a house. Let's use our credit card to go buy more stuff. That's all that's saying. That's the data. That's not me just, guessing. Also, lending standards are also tightening up. So people don't want to make loans to someone who can't quite prove their income and all that great stuff there. Lending standards were the tightest for construction developments. That gives you an idea what's going on there. And also tightening up for commercial loans for large companies and such. Consumer loans for autos, consumer loans for credit cards. All of that's getting tighter out there. So just pointing those kind of fun things out. Anyways, so when we look back at Rocket, you can kind of understand it's going to be some tough sledding for them for a while there. Occidental Petroleum comes out with earnings. They beat by 3%. They chose to say production's going to stay just as it is. We are not going to invest in more production, more efficient production. We're not going to go do more. Nothing. They're like, you're just going to keep it just like this. They guided that way for the rest of the year. So it gives you an idea of where they stand. They're happy to just sit there and make the money they are because they're unsure. It's not that they're bad people and they say, well, let's just soak up all this money. Of course, they want to drill more or produce more if they can. They've decided, no, our money is better spent on stock. Maybe Warren Buffett had something to do with that, but they've decided that's what their game plan is for the rest of the year. Coinbase down 26%. Again, if you own this crypto, Bitcoin, stablecoin, any random coins, and you're nervous about the stock market, shut up. You know what I mean? Come on. Coinbase. Crypto trading was the big flaw here. This is naturally more of a crypto thing. This is why we focus on this. Crypto trading basically fell off a cliff as well. Revenue missed by 21%. The number of transacting users fell 19%. In other words, people are like, I'm just going to cash out. I need the money. Where's the first place I'm going to go to get my money? crypto. Why? Because there's nothing there. There's no use in having it. If you need the money, you can't spend it, but you need the money. I'm going to sell my crypto. That's what people are saying. Trading volumes in general fell 44%, and the total assets that are on the platform down 10%. It's the first place. I've said this, countless times. When the economy gets weak, people usually go to their IRAs and they say, well, I'm going to take a few dollars out of that. But no, everybody's got a little Bitcoin or crypto, and they're like, I'm not going to pay over here. I can just go to my crypto and sell it. That's the pressure you have right now. It won't last forever, but you get what I'm saying. And lastly, Wendy's. I thought you guys like Wendy's there. Weaker than expected. Earnings, revenue, guidance was okay. Oh my gosh. They've got a problem there. That's the definition of a waterfall drop. A waterfall doesn't fall straight down. A waterfall rolls down. You see that there? Not a good time to pretend that you like Wendy's there. And I think Five Guys, right? Five Guys kind of got them beat, doesn't they? They're pretty much everywhere. If you had to pick Wendy's or Five Guys all day long, right? Tomorrow you've got earnings from Affirm. Remember, there are more people buying now and paying later, especially the younger crowd. Expect to hear something about that. Alibaba, Dillard's, we start the retail side of things. They're going to be reporting. And Tapestry, that's another retail company there. We also have natural gas numbers coming out. Remember, natural gas is the hottest commodity at the moment, even though it has fallen a little bit. You've got some Fed members speaking there. And speaking of industrials from earlier, Goldman Sachs has the industrial conference. You know how they have like the JP Morgan healthcare conference and everybody looks at that? This one's for industrials. So if you see some weirdness going on there tomorrow, it's likely because of comments that were that came out there. There is a healthcare conference tomorrow, but it's Bank of America, and it's less popular than the JP Morgan one. Oh, I'm sorry. So Kirk, I might have insulted you then. Enjoy your Wendy's. I'm a Five Guys guy. You know what I mean? It's the peanuts. I can sit there and eat peanuts while I'm waiting. Come on. Yeah. Wendy's, man. Alibaba with their earnings. So they're going to have, technically tonight. We'll find out about it tomorrow. It's their chance. It is yet to try to make any kind of a bounce there. Turnaround Thursday? I don't know. When you least expect it. We need something, right? It's like mom and dad are fighting and you need some good news to let you know they still love you. They just are having an argument, That's where the stock market's at with Congress and with the Fed and everything. Let us know you still care. Give us something to do it, but no. Disney fun fact coming up. I was ready, but nope, Disney's down after hours. Disney was down on the day, down after hours. No Disney fun facts when Disney's down, only when it's up. They have to hold up their end of the bargain there. Yeah. Still think Roku gets bought out? Sure. Yeah, I wouldn't. The price of Roku wouldn't change my belief there. If anything, it kind of helps them. The trouble is now it has to make sense. Money was loose, and you could buy whatever you want. Now, who's going to step up and say that's a worthwhile thing for us to spend money on when maybe these companies don't have as much? So it's looking a little bit nastier, but there's always a chance. Five Guys and their fries. Yeah. That's true. I'm hungry now. Any thoughts on Starbucks at 70? Pretty general question, just wondering what you would think of it. So, no, I don't. I like the idea, and I still have an option left from our office trades, I think, if it hasn't been assigned yet. I didn't get a chance to look today. I still I'm willing to get assigned on that one. So if it's one of those things where you're saying, I'd like to trickle in, take a shot on Starbucks, you got a lot of headline risk there right now, but that's fine. Yeah. Has the market priced in a recession? I think we're going to find out that this actually is a recession. It's too soon to say that, of course, but we're getting there. Coming up on our next GDP number. It's about a month and a half away still. Yeah. How do you get the put-call ratio chart? It depends on the platform. Sometimes you can just literally type put/call or call/put to see the chart that way. There's usually a shortcut to type in there. I would check that out. Yep. Do you believe the future rate hikes are already priced in? I don't have to believe it. You can actually see it. So you can actually see where interest rates are relative to where the Fed wants to be. I shared that a while back, put it on the chart there. So yes, they've overpriced it at the moment. Or they assume more rate hikes than what the Fed is going to do. So I think they're still pricing in like 8 or 9 more hikes. Not that that's not possible, but that's what people have priced in. Uber don't make no money. Yep, that's right. McDonald's, yeah, think of all the things that people are like, I don't know. Nike, it's fine. McDonald's, right? Probably Home Depot. That's a tough one. I shouldn't have said that, but you get what I'm saying. Alcohol, tobacco, if that's okay with you. Starting to think your ARK investments are nothing more than mean ETFs. I don't blame you. That's rough going over there right now, huh? That is rough going. What's your take on Adobe? So this would fall into... it's off the chart. It falls into everything else. There is no good reason to try to guess this is the bottom. Normally, in any normal market, you go, all right, we got a downtrend here. Show me some sign that other people want to play along. Higher volume, temporary news spike, any solid day that closes at near its high of the day. And you would say, I'm going to take a shot, right? But I don't think that's the time right now. You would be guessing that not only does that whole sector start to turn around, but so does the market. So that's a tough one. Apple's also very extended as well. Yep. Yep. They call it a Putin recession. I saw that being Putin inflation and all that. And I'm like, yeah, that's the trouble. We can see the data, though. Anybody that's willing to take a second and look it up. You can blame some of it. You can't blame all of it. Doesn't matter what side you're on. You can't argue that. That's a tough one. That's like the Tyson Foods profiteering off of supply chain. No. We can clearly see that that's not the case. Don't start that stuff. Yep. You feel it's a worse time than the COVID time? Well, you can look at it, and I've shared this chart in our Notes from Jazz emails before. So when you look at the long-term performance of the market, I had plotted out where the COVID high was, where the COVID low was when we pulled back, 10% from there. What would that look like? A bear market. It really is still a blip on the radar as far as a long-term view of the market, but it's no fun. I'll give you that. Yeah. Yep. Yeah. You guys, there you go. Still get along. You have a difference of opinion, but you still get along. Where did the world go wrong? We stopped doing that. Yep. Hey, also, we got to take a little bit of blame ourselves here. I mean, I'm all for beating up on some politicians, but we did go out there and buy a whole lot. Did you see airfare? The price of airfare is up like 36%. That was in the inflation numbers. Hotels, travel, and stuff. So we're out there contributing to this for the moment, and clearly showing that gas prices don't matter or whatever. So I think the kids have to take a little blame as well. We all have to, stop spending money. Yep. Oh, you got out in January. They're good. That's kind of like us here. We had sold through October, November, and December. We had just been selling little by little, just quietly selling off 1%, 1%, 1%. And so now that the markets have fallen, it's been great for us because we haven't fallen as much as the market. Short pitch here. At Jazz, we manage our own portfolios. So that was awesome. So now the markets have fallen. All of our clients are like, hey, how do we take advantage of this? Rather than going, oh my God, my account is down. And, so I don't have to deal with that. But like I say, I run into the fire. I don't run away from it. So some of you may need to look away a little bit. But we'll get there. Hey, we'll also be back tomorrow to do this all over again because it will likely be another exciting day. So stay tuned and enjoy the rest of your evening. We'll see you tomorrow.